Financial markets don't run on numbers alone, they run on trust. And one hidden conflict, one misleading performance chart, or one piece of misused confidential information can destroy it. This lecture exposes how manipulation, insider trading, misrepresentation, and biased recommendations corrupt decision making, and gives you a practical test. Would the action still look defensible if everyone could see the full story? We will study market integrity, misconduct, and ethical investment recommendations. This topic is extremely important because finance isn't only about prices, returns, models, and portfolios. Finance is also about trust. Investors participate in markets because they believe the process is reasonably fair. They believe information isn't intentionally distorted, recommendations aren't secretly biased, and professionals aren't using privileged access to take advantage of them. Market integrity means that prices, trading activity, and investment communication aren't intentionally manipulated by fraud, deception, concealed conflicts, or unfair informational advantages. Notice something important here. Market integrity doesn't mean every investor has the same information, the same skill, or the same resources. Some investors will always be more informed, more experienced, or better equipped. That is part of markets. The ethical problem begins when a professional misuses confidential information, deceives investors, hides conflicts, or presents risk in performance in a way that a reasonable investor would misunderstand. So throughout this lecture, keep one question in mind. Does this action preserve the trust that makes financial markets possible? Let's begin with why ethics matters for price discovery. A well-functioning market gathers information from many participants. Analysts study companies, investors compare risks, traders provide liquidity, issuers disclose information. All of this activity flows into prices. Prices are never perfect. Markets are noisy, uncertain, and sometimes emotional. But prices become much more useful when investors believe the process isn't rigged. Misconduct damages this process in several ways. Trading on material non-public information creates unfair advantage. False promotional campaigns create artificial excitement. Manipulative trades can make volume and price movement look meaningful when they are actually engineered. Misleading performance reports can send capital toward managers or products that don't deserve it. And when investors lose confidence, the damage spreads. They may demand higher returns to compensate for integrity risk. They may avoid certain markets. They may become suspicious of professional advice. This is why ethics isn't a side issue. It affects client retention, fundraising, regulation, reputation, and the ability of markets to allocate capital efficiently. Legal compliance is necessary, but it isn't enough. A professional must also ask whether the conduct is honest, fair, competent, and defensible if clients, regulators, firm leaders, and peers reviewed the full story. Now let's discuss material non-public information, often called MNPI. MNPI combines two ideas, materiality and non-public status. Information is material when it would likely matter to a reasonable investor making a decision to buy, sell, hold, or recommend a security. Material information doesn't have to guarantee a price change. It simply has to be important enough that it could change the total mix of information available to the market. Information is non-public when it hasn't been broadly shared with the market in a way that gives investors a fair chance to absorb it. A confidential email, private meeting, restricted data room, draft announcement, board packet, or selective briefing may involve non-public information. Examples of potentially material information include unreleased earnings, merger plans, major regulatory decisions, significant litigation, liquidity problems, major leadership changes, cybersecurity incidents, or important operational disruptions. The ethical question isn't only, can I prove this information is material? A more careful professional asks, did I receive this through a relationship of confidence? Would trading or recommending before public release give me or my clients an unfair advantage? That careful question protects the professional, the firm, the client, and the market. Insider trading and tipping are among the clearest threats to market integrity. Illegal insider trading generally involves trading securities based on material non-public information in breach of a duty of trust or confidence. It can also involve tipping information to someone else or trading after receiving a tip that shouldn't have been shared. However, not every trade by a corporate insider is illegal. Officers, directors, and employees may trade when they follow applicable laws, company policies, trading windows, reporting rules, and don't trade on MNPI. The ethical concern arises when confidential information is used for personal benefit or to benefit selected clients, friends, family members, or business associates before the market has fair access. So what should a professional do when MNPI might be involved? Stop using the information. Don't trade. Don't recommend. Don't encourage others to trade. Preserve confidentiality. Escalate the issue to compliance or an appropriate supervisor. Document the source, timing, people involved, affected securities, and actions taken. When unsure, treat the information as restricted until reviewed. This may feel cautious, but caution is part of professionalism. Investment gains should come from analysis, risk-bearing, and legitimate research, not from misusing entrusted information. Next, let's examine market manipulation. Market manipulation occurs when someone tries to distort price, volume, liquidity, or investor perception through false signals or deceptive activity. Manipulation can happen through public statements, private messages, trading behavior, order book activity, coordinated campaigns, or selective presentation of information. A pump and dump scheme spreads false or misleading positive information to inflate interest, while the promoter sells into that artificial demand. A short and distort campaign spreads false or misleading negative claims after taking a position that benefits from price decline. Wash trading creates the appearance of activity without genuine economic change. Painting the tape creates misleading impressions of market interest. Spoofing and layering use orders without genuine trading intent to create a false view of supply and demand. The details may differ, but the ethical problem is the same. The professional is trying to profit from a false market signal. Markets depend on price and volume as information. When manipulation occurs, those signals become unreliable. The ethical line is crossed when a participant benefits not from research, liquidity provision, hedging, or risk-taking, but from deception. In finance, persuasion is allowed. Optimism is allowed. Strong opinions are allowed. But hidden self-interest and false signals aren't ethical market behavior. Fair dealing is another foundation of investment ethics. Fair dealing means treating clients, prospective clients, and other market participants honestly and without improper favoritism. This doesn't mean every client receives identical advice, identical timing, or identical execution. Clients are different. They have different objectives, risk tolerance, liquidity needs, tax situations, legal constraints, investment policies, and account characteristics. Fairness means that differences in treatment must have a legitimate basis. Fair dealing becomes especially important when research or recommendations may move prices. Suppose a firm releases a major recommendation to selected clients first. Those clients may trade before others even receive the information. Even if the research is valid, selective dissemination can create unfair advantage and reputational risk. A fair recommendation process should consider who receives the recommendation, when they receive it, whether the recommendation is suitable, how trades are allocated, how conflicts are disclosed, and how errors are corrected. This isn't just an individual ethics issue, it is also a process control issue. Firms need policies for research distribution, trade allocation, personal trading, account priority, soft dollar arrangements, and error correction. Good intentions are helpful, but in fast-moving markets, good systems are also necessary. Now, let's turn to misrepresentation. Misrepresentation occurs when a professional knowingly or carelessly creates a false impression. It can be an outright false statement, but it can also be a misleading omission, a half-truth, an exaggerated claim, inappropriate use of credentials, plagiarism, or presentation of data without necessary context. Misrepresentation can appear almost anywhere. Research reports, sales decks, client letters, consultant databases, pitch books, podcasts, interviews, social media posts, and private conversations. The key idea is simple. A statement can be technically accurate and still be misleading. For example, a performance claim may sound impressive, but if it hides the relevant benchmark, risk exposure, fees, liquidity limitations, or unfavorable periods, investors may walk away with the wrong conclusion. Ethical research and investment presentations require a reasonable basis, a clear distinction between fact and opinion, balanced discussion of risk and return, and disclosure of conflicts. A defensible recommendation should explain the action, the time horizon, the valuation basis, expected risks, relevant comparisons, conflicts, data sources, and important limitations. Being wrong isn't automatically unethical. Markets are uncertain. The ethical failure occurs when the professional lacks a reasonable basis, hides contrary evidence, overstates confidence, misuses confidential information, or allows conflicts to dominate judgment. Performance reporting deserves special attention because investors often use past performance to infer investment skill. But past performance doesn't prove future performance, and raw return figures can be shaped by time period selection, benchmark choice, risk exposure, leverage, fees, taxes, liquidity, survivorship, and valuation methods. A good performance presentation should help investors understand what return was earned, what risk was taken, what benchmark is relevant, and whether the results reflect skill rather than market exposure, leverage, liquidity risk, or luck. Arithmetic averages describe the simple average of periodic returns. Geometric averages describe compound growth over time. Active return compares portfolio performance with a benchmark. Tracking error helps us understand how much active return varies. Information ratio connects active return to active risk. Sharpe ratio relates excess return to total volatility. These measures are useful, but they don't automatically make a presentation ethical. They can mislead if the benchmark is wrong, the period is too short, illiquid assets understate risk, or costs are excluded without clear disclosure. Let's continue with benchmark ethics and conflicts and recommendations. A benchmark should represent the investment universe, risk exposures, constraints, and opportunity cost relevant to the strategy. Benchmark choice isn't cosmetic. It shapes whether performance appears strong, weak, risky, or skillful. A defensible benchmark is chosen before performance is evaluated. It should be economically meaningful, aligned with the strategy, transparent when possible, and used consistently unless a change is clearly justified and disclosed. Benchmark problems often arise when a strategy is compared with an index that makes performance look better but doesn't represent the same risks. A risky strategy shouldn't be made to look superior simply by comparing it with a low-risk benchmark. An illiquid strategy shouldn't be presented as if its smooth returns mean it has low economic risk. Now connect this to recommendations. Investment recommendations combine analysis, judgment, persuasion, and incentives. Ethical problems arise when the recommendation serves the professional's interest while being presented as objective advice. Conflicts may involve ownership of the security, transaction-based compensation, asset gathering pressure, product placement fees, investment banking relationships, personal trading, or pressure to maintain issuer access. Disclosure is important, but disclosure alone doesn't solve every conflict. Some conflicts must be avoided, reduced, or controlled through procedures. Ethical recommendations require a reasonable basis, suitability, clear risk disclosure, fair distribution, monitoring, updating, and records that support review. Let's finish with a practical ethical decision-making framework. Ethical problems in investment practice often arise under pressure. A client wants an answer. A trade opportunity appears. A report is ready to publish. A performance slide looks persuasive. A confidential comment creates temptation. A framework helps us slow down before damage occurs. Start by defining the action clearly. Are you trading, recommending, publishing, marketing, sharing information, or reporting performance? Then identify the stakeholders: clients, prospective clients, the firm, employees, issuers, counterparties, regulators, the investing public, and the professional may all be affected. Next, identify duties. Duties may come from law, regulation, fiduciary relationships, client agreements, confidentiality obligations, firm policies, and professional standards. Then identify conflicts. Who benefits? Who bears the risk? What compensation is affected? What relationships could bias judgment? What facts might be hidden? Test the information. Is it reliable, public, complete, current, and used consistently with confidentiality duties? Evaluate alternatives. Delay the action. Disclose more clearly. Change the recommendation. Restrict trading. Correct the presentation. Escalate and document. The goal isn't to create a mechanical checklist. The goal is careful professional judgment. Thank you for watching. I hope this lecture helped you understand why ethical conduct is central to investment practice.